we were at fair value, got a little bit above fair value, and we were on our way to maybe 1.5, 1.6 times fair value, because there's not as much leverage because FTX went away and a couple of the other exchanges, were lowered the amount of leverage you could get. What I think happened here was a premature unwinding of the Bitcoin trade. My guess, now I could be wrong, but my guess is we'll get through this, the trade war won't happen, Trump will back down, and we'll get a slow and steady resumption of the trend through summer and into fall. We'll get that last speculative blow off, but then crypto winter will be back. Yes, you have this up and down, but it's a series of higher highs and higher lows. And that's what we've had, right? We went from nothing to $10 to $100 to $1,000 to $5,000 to $20,000 to $100,000, eventually to $1 million.
A key part of Yusko's analysis is how market participants behave at different price levels. When Bitcoin is undervalued, strong-handed investors accumulate. As it reaches fair value, traders and speculators jump in, adding liquidity and volatility. Then, leveraged gamblers enter the market, causing an excessive price spike. When the leverage unwinds, Bitcoin experiences a sharp decline. Yusko suggests that the current cycle may not see as deep a correction as past ones. Previously, Bitcoin crashed 84% in 2 consecutive cycles, followed by a 73% drop. In this cycle, if Bitcoin peaks around $150,000, a drop to $75,000 would be expected. However, if $107,000 was the peak, the correction may only be around 30%.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The reality is Bitcoin is the most secure network on the planet because of this mining system and because of this incentive structure. But our costs, your costs and my costs, are fixed. So if they cut the rewards in half, one of us has to go out of business unless the price rises. So we both hold on to our Bitcoin longer, and we require that someone bid a higher price in order for us to sell. So there's a natural increase in the price every 4 years. The fair value basically goes up. Well, why does that matter? Well, here's the cool part. So because of this 4-year cycle, we get the price move in a wave above and below fair value. So the halving tends to occur after a period of crypto winter, right? Crypto spring, crypto winter, markets are falling. Crypto spring, they're kind of settling. Then crypto fall, the halving occurs and the price starts to move back towards fair value. Well, think about it. When the price falls during crypto winter, meaning people get afraid and they sell, and the price falls way below fair value, who buys? Investors. Investors like to buy things that are below fair value. So the investors quietly accumulate when it's below fair value. So remember the last cycle, we got all the way to 69,000. That was double the fair value of 32, and it sold off all the way down to 15. So the fair value just keeps accreting up, 32, 35, 38, 40, just as the cycle continues to go. And the investors started to buy, and the price crept from 15 to 20 to 25 to 30. The ETFs happen, then it goes. So then the halving occurs last year. Fair value was somewhere around 50. Okay, well, what happens? The block rewards go down, the price has to start go up. So now fair value jumps to 95. The price starts to approach 95. Well, what happens when the price starts to move? This is the genius of the halving. Traders come in. Traders don't care about fair value. They just want movement. Well, then what happens is we get back to fair value. Then you and I, as the miners, are willing to sell. We hedge our production, meaning we have to pay our bills. So we sell in the futures market. We're hedgers. Speculators have, for every transaction, there has to be someone on the other side. So if you and I are selling, that speculators have to come in and buy. They don't care about the asset. They just want to take the other side of hedgers because the hedgers have to sell. So the speculators come in, price starts to move some more. Well, then the bad thing happens. So then the gamblers come in. And the gamblers come in and they borrow money. So they use leverage and they push the price well above fair value. And that triggers the whole cycle again, because once you get too far above fair value, and in the past cycles, we got to 2 times fair value because there was a lot of leverage. Once that leverage unwinds, which we're seeing right now, then things can get dicey. Now, I will argue that we were at fair value, got a little bit above fair value, and we were on our way to maybe 1.5, 1.6 times fair value because there's not as much leverage because FTX went away and a couple of the other exchanges, were lowered the amount of leverage you could get. So we're starting that parabolic move toward 150, 160. Well, then this crazy thing happens with tariffs and all this stuff, and people are panicking. Well, what happens? The stock market was super overvalued coming into this year, globally, particularly in the US. People were levered up. We had the highest margin debt in history. So then NVIDIA happens, DeepSeek, and things and the Mag 7 start to sell off. People are getting margin calls. When you get a margin call and you're invested in stocks and your stocks went from here to here, you don't sell the stocks. You sell the stuff that hasn't moved. So you sell bonds or gold or Bitcoin to pay off your margin call. So that starts an unwinding of leverage. So what I think happened here was a premature unwinding of the Bitcoin trade. My guess, now I could be wrong, but my guess is we'll get through this. The trade war won't happen. Trump will back down and we'll get a slow and steady resumption of the trend through summer and into fall. We'll get that last speculative blow off. But then crypto winter will be back. And how bad crypto winter gets, I don't really know. But given history, if we go up less, we probably go down less. So we went, down 84, down 73. So probably less. If we got to 150, would we fall to 75? That seems more. Now, if we don't get back, like if 107 was the peak, then I think this downdraft won't be as big, right? Maybe it'll only be a 30% drawdown. You need to be above fair value in order to have a really deep correction. And if you're 2 times fair value, an 84% drop, right, takes you well below fair value, but it doesn't take you to zero, right? It actually, and again, long story. But what I think is interesting is every one of these cycles, it's not like on a roller coaster, right? You end up at the same place. You got the highs and the lows, but you end up at exactly the same place at the end of the trip. That's not how Bitcoin works. That's not how networks work. Yes, you have this up and down, but it's a series of higher highs and higher lows. And that's what we've had, right? We went from nothing to $10 to $100 to $1,000 to $5,000 to $20,000 to $100,000, eventually to $1 million. But there's a volatility, and the media will say, "Oh, it's crashing." There was a story when it crashed from $10 to $2, and then it went back to $100. Then there was a story when it crashed from $100 to $30, and then it went back to $1,000. And then there was a story when it crashed from $1,000 to $300. There's always going to be a story. I mean, there was a story last week that it crashed from 107 to 79. I'm like, you realize you're talking about a negative of something that started as zero 16 years ago and now $79,000 per coin. Crazy.
One of Bitcoin's key advantages over gold is its divisibility and portability. Unlike gold, which is cumbersome to store and transport, Bitcoin can be divided into satoshis, 100 million per BTC, and sent instantly across the globe. This makes Bitcoin a more efficient store of value for the digital age. Yusko highlights that throughout history, fiat currencies have failed, with over 775 paper currencies collapsing. Bitcoin, by contrast, represents sound money with a fixed supply and an immutable ledger, making it the best hedge against monetary debasement.
You should have your liquidity bucket, 10 to 15% in liquid fiat, because we still live in a fiat world, right? Then you should have, 10 to 15% in your get-rich bucket. And that's whatever you want to do. Venture capital, hot stock tips, real estate, whatever. And that drips down, that's got a hole in the bottom, and that drips down into your stay-rich bucket. Your stay-rich bucket, 70% of your assets, has a little hole in it, and it fills up your liquidity bucket that you spend every year. So in that savings bucket, I could argue that a big chunk of that should be Bitcoin. I would argue it's the endowment model of investing, so venture capital and stocks and bonds and currencies. But increasingly, I want to have less in fiat and more of my savings, true savings, in Bitcoin to preserve the purchasing power. The problem with gold, it's not very divisible. Like if I had a gold bar here, which I don't, but if I did, and I wanted to break it in half and give you half, I'm just not strong enough to break it in half. So it's not very divisible. And it's not very portable. Like I couldn't stuff it in the computer and send it to you. Now, I can send you any amount down to, you mentioned, before we went on air that, my handle on Twitter is 2.1 quadrillion. And why is that? Well, there are 2.1 quadrillion Satoshis, 100 million Satoshis per Bitcoin. So 2.1 quadrillion. So it's a lot of Satoshis. And so I can send you a very, very tiny amount of Bitcoin instantaneously with a couple taps on my phone. And it's very portable, like in the sense all the Bitcoin in the world fits on this phone. Now I don't have any on my phone, so don't SIM swap me. If you're, that's happened twice, but I don't keep it on my phone, so you're not going to steal anything. So that's again a long-winded way of saying it was a series of incremental discoveries about why Bitcoin is the perfect future money. And in history, there's something called Gresham's Law. And bad money crowds out good. So every time a bad money is created, people will flock to it because they think it's going to be worth more. And so in the history of mankind, there have been 775-ish paper currencies. 3/4 of them no longer exist.
Mark Yusko's insights offer a masterclass in Bitcoin economics. Understanding Bitcoin's halving cycle, fair value progression, and market psychology allows investors to navigate volatility with confidence. While short-term price movements may be unpredictable, Bitcoin's long-term trajectory remains clear. A continual rise in value driven by scarcity, adoption, and network effects. As Bitcoin matures, it is increasingly becoming the preferred savings technology for those looking to escape fiat inflation. The message is clear. Those who understand Bitcoin's cyclical nature and game-theoretic design are positioned to benefit from its inevitable rise. Please like and subscribe.